If you're over 60 and you still have a checking account, there's something happening inside the IRS right now that never made it into a press release, never showed up as a letter in your mailbox, and never got explained to you by your bank teller. 3 separate changes to how the government watches ordinary bank accounts quietly went into effect, and almost none of the seniors I talked to have any idea these changes apply directly to them. This isn't about people doing anything wrong. It's about ordinary, everyday banking habits, the kind almost every retiree has, suddenly being read differently by a system that used to ignore them. I'm going to walk you through all 3, one at a time, and I want you to actually pay attention to the third one, because it involves something almost every senior does without a second thought, and it's the one most likely to catch someone off guard months from now, long after the transaction itself is forgotten. My name is Lana Maines, and I spend my time explaining the financial and legal rules that quietly affect retirees. The kind of rules that never get explained to you unless you happen to already know the right questions to ask. If that's useful to you, stick around, because understanding this now could save you a very uncomfortable phone call later. For decades, the number every retiree learned to watch was $10,000. Stay under it, and you were told you were fine. That number came from the Bank Secrecy Act, and it's still technically true that any cash transaction over $10,000 in a single day requires your bank to file a report with the federal government, one that includes your name, your social security number, your date of birth, and the precise time of the transaction. You will never see that report. Your bank is legally forbidden from telling you it exists. But here's what's changed, and this is the part that catches people off guard. The threshold itself was never really the protection people thought it was. What's shifted is what the system is now paying attention to underneath that number. Regulators have sharpened their focus on accounts that show a repeating pattern of deposits or withdrawals that sit just below $10,000, especially in accounts belonging to retirees receiving Social Security, pension distributions, or regular family support. In other words, the number itself was never the finish line. It was always about the pattern surrounding it, and that pattern is now being watched far more closely than most people realize. There's also a second kind of report almost nobody has heard of, and unlike the $10,000 rule, this one has no floor at all. It's called a suspicious activity report, and a bank can file one over a transaction as small as a couple $100s if internal software flags unusual behavior, not necessarily unusual amounts. You will never be notified. In fact, it is a federal crime for any bank employee to tip you off that one was filed, punishable by years in prison. And this isn't limited to big national banks either. If you moved your money to a credit union thinking smaller, local institutions play by different rules. They don't. Every federally insured bank and credit union in the country follows the exact same reporting requirements under federal law. There's no safer harbor by switching where you keep your money. The only real protection is understanding what actually triggers scrutiny in the first place, because the account number on your statement was never what mattered. The pattern behind it always was. Let me tell you about a woman I'll call Carol, 68 years old. A retired hospital administrator living outside Sacramento. For 9 years, Carol withdrew $600 in cash every other Friday to cover groceries, gas, and the small cash expenses that build up over a month. It was a routine as steady as clockwork, the kind of habit you build after decades of managing a household budget carefully. When her husband passed away last year, she took over paying for the lawn service and the home maintenance costs he used to handle directly in cash, and her withdrawal amount crept up to $900 every 2 weeks. Nothing dramatic, just a widow adjusting to a new set of bills. About 2 months later, her bank's monitoring software flagged the consistency of that pattern and filed a suspicious activity report without her knowledge. Carol had done absolutely nothing wrong. She was simply managing her own money the way she always had, only now doing it alone. She didn't find out anything had even happened until a routine account review months later when a compliance officer asked her to explain the shift in her withdrawal habits. Thankfully, she'd kept receipts for the lawn service and the home repairs and was able to show exactly why her pattern had changed. But she told me afterward that the unsettling part wasn't the questioning itself. It was realizing that a report had been sitting on her account for months and she'd had absolutely no way of knowing. What happened to Carol has a name. It's called structuring, and it falls under federal law that doesn't require any proof of bad intent at all. It only requires a pattern that resembles someone trying to stay just under a reporting threshold, regardless of where the money came from or how legitimate it actually is. Regular withdrawals or deposits sitting consistently below $10,000 can qualify, even when every dollar involved is completely clean. If you're someone who relies on cash regularly, whether for groceries, home repairs, or helping out a family member, the real protection isn't changing your habits, it's documenting them. A simple written note each time, the date, the amount, and the reason, creates a paper trail that can clear up a misunderstanding in minutes instead of months. And if you're planning to move a larger sum of money between your own accounts, it's far better to do it as one clear transfer with a brief note about its purpose than to break it into several smaller transactions that could read as an attempt to stay under the radar. Before we get to the third change, and this is genuinely the one that surprises people the most, take a moment and think back over your last few months of banking. If you've noticed several deposits landing consistently in that $5,000 to $9,000 range, hold that thought, because you're going to want it when we get to the action steps at the end. What comes next involves money that most seniors never even think of as income in the first place. Money sent by their own children, for groceries, for a car repair, for something as simple as helping cover a utility bill. And it's turning into one of the most common and most avoidable letters retirees receive from the IRS. Here's the third change, and it's the one that catches the most people off guard because it doesn't feel like it should involve the IRS at all. Your daughter sends you $300 through Venmo to help cover a prescription. Your son sends $400 through Cash App because he wants to chip in on a car repair. None of that feels like income. It feels like family taking care of family, the same way it always has. But under updated reporting rules, third-party payment apps like Venmo, PayPal, and Cash App are now required to report cumulative payments landing in your account once they cross a certain threshold within a calendar year. And that threshold has been dropping fast, moving from a much higher number down toward just $600 total across the year. Zelle works a little differently because it processes as a direct bank-to-bank transfer rather than through a third-party platform. So it isn't swept into this particular reporting requirement, though any income that happens to be genuinely business-related is still taxable no matter which app carries it. The real issue is what happens when one of these apps reports a number to the IRS that never shows up anywhere on your tax return. The IRS's computer system doesn't pause to consider context. It simply notices a mismatch and generates a letter automatically. That letter is called a CP-2000, and it isn't technically an audit. It's a proposed adjustment to what you owe, usually with interest already added on. Let me tell you about a retired nurse I'll call Ruth, 72 years old, living outside Columbus, Ohio. Ruth hadn't worked in over 3 years. She lived on a modest pension and Social Security, nothing unusual there. But over the course of 1 year, her 2 adult sons had sent her a combined total of just under $2,800 through Venmo, covering things like her heating bill during a rough winter and a replacement washing machine after hers broke down. None of it was income. All of it was family helping family. But when tax season came around, the payment app reported that total to the IRS as gross payments received. And because none of it appeared anywhere on Ruth's return, the system flagged the gap automatically. Months later, she opened a letter stating she owed over $1,000 in taxes she'd never actually earned. She had 60 days from the date printed on that notice, not the day she happened to open the envelope, to respond before the adjustment became final and enforceable. The fix for something like this is almost embarrassingly simple, but it has to happen before the letter ever arrives, not after. If your children or family members are sending you money through any of these apps, ask them to write a short note in the memo line, something as simple as gift or family support every single time. Gifts from family members are not considered taxable income to the person receiving them, but the burden is on you to be able to show that's actually what the money was, and a memo line takes 2 seconds to write and can save you weeks of stress later. It also helps to keep a simple running log yourself, just a note of the date, the amount, and who it came from, especially if this is a recurring thing rather than a one-time transfer. And here's something most seniors don't realize at all. The IRS generally has 3 years from the date you filed a return to come back and question it. But that window stretches all the way out to 6 years if the unreported amount turns out to be more than 25% of what you actually claimed that year. That means a mismatch from 2 or 3 years ago, something you've completely forgotten about, can still resurface today with interest attached, even if no notice ever came at the time it actually happened. If you've been receiving regular help from family through these apps for a while without tracking any of it, it's worth pulling up your last few years of transaction history now, not just this year's, so you're not blindsided by a notice covering a year you'd already stopped thinking about.
So here's what I'd actually do about all 3 of these changes, starting today, rather than waiting for a letter to show up. First, take a look at your last 90 days of banking activity and note anything that looks like a repeating pattern, regular withdrawals or deposits that consistently land somewhere between $5,000 and $9,000. If you spot that pattern, and it's simply how you manage your own money, that's fine. Just start keeping a brief note each time explaining what it's for. Second, if you're moving money between your own accounts in larger amounts, consolidate it into one clean transfer with a short memo describing the purpose, rather than breaking it into pieces that could read as intentional avoidance. Third, if family members regularly send you money through Venmo, Cash App, or PayPal, ask them to label it clearly as a gift every time, and keep your own simple log alongside theirs.
Fourth, add up everything you've received through these apps over the past 12 months. And if that total crosses $600 and isn't reflected anywhere on your return, gather your documentation now before any letter has a chance to show up. And if a CP 2000 notice does arrive, respond in writing before the deadline printed on the notice itself. Include a clear explanation along with whatever documentation you have, and if the amount in question is significant, it's worth looping in a licensed tax professional before you send anything back. None of these 3 changes came with a warning, and none of them were ever going to. Your bank isn't allowed to tell you when a report gets filed, and the payment app sending money between you and your kids has no obligation to explain what it just reported to the IRS on your behalf. That silence isn't an accident. It's simply how the system was built. The only real protection any of us have is understanding these rules before they show up as a letter and making sure the paper trail already exists long before anyone ever asks for it.